Hey everyone, welcome to the Walk to Wealth podcast. No matter what directory you're tuning in on, whether it's YouTube or Apple Podcasts, Spotify, make sure to tune in till the end of this episode. I have a very special guest. Mark, for anyone that may not know you, tell us a little bit about yourself. Tell us your elevator pitch. Who are you and what do you do?
Well, thank you. Been just a wild, crazy journey these last many years. I've had the great privilege of working with people straight out of college to business owners to real estate investors, even NFL Super Bowl champions. But the vast majority of the people I work with just want some more agency. They want some more control. They want some more certainty over their life. I feel like all of us could probably say that over the last 3 or 4 years, life has been anything but certain. And we've given ourselves, I think, a long way to climb out of a hole that a lot of us fell into, whether it was with our BMI and our weight or our financial life. We put off big decisions, whatever, or we stumbled into a ton of debt. So a lot of folks have talked to me and they said, Mark, the last 2 or 3 years just sort of felt like I was a tennis ball floating down the gutter of life. And I want to start swimming upstream financially. And I love that metaphor and I love that concept of learning to just get off of the lazy river and to start to swim upstream. And that can look so beautiful and so custom to each person. But that's what I've got the great privilege of doing as a certified financial planner, working with folks all around the country.
Amazing, Mark. And tell us a little bit about your walk to wealth, right? Before all the financial planning, before you got to doing what you're doing today. Where does this story all start?
Well, I didn't grow up with much or really any kind of silver spoon in my hand. I didn't know much about money. When I went to college, I just sort of signed on the dotted line, not knowing what that was going to do to my financial future as I got into 6 figures of student loan debt. My wife and I graduated from our private school degrees. I carried most of it, but it was $120,000 of student loan debt. And we graduated in 2008. So, John, that's like a great time to be looking for work. You know what I mean? So and we didn't really have marketable degrees either. So we were just scratching together whatever we could to make the payment. Jokingly told my wife that I had married 2 women in college. I married her and I married Sally Mae. And so that's been a transformational story because I didn't know much about money and yet I was in so much trouble with it. And I feel like that's how most of us live our life. We become young adults and we're just sort of handed student loans. We're handed credit cards. Maybe if we get the day job, we get that 401k handed to us. And we don't really know why we're doing what we're doing. It's sort of like if you walked into a movie theater like 45 minutes late and you don't know why the people are doing the things they're doing on the screen. Why am I investing in mutual funds? What is an interest rate on my credit cards? I'm supposed to put how much down to buy a house? And I'm supposed to have that much in my student loan pocket debt as I get out of college. So all of these things are just sort of handed to us and we don't know why we're doing what we're doing. Just like we don't know on the screen on that movie theater, like why did that dude just punch that other dude? Or why are they kissing? Or why is this building blowing up? We walked into the movie without knowing the real plot. And even William Shakespeare says that all the world is a stage and all of us merely characters on that stage, but we don't know what part we're supposed to play, I think is the part. And we don't know what part money is supposed to play. We don't know if it's a villain. We don't know if it's a love affair. We don't know if it's a road tripping buddy with us. So what is the character of money in our lives and how do we integrate it in a healthy way? That's, I guess, my own story. And I think what I see a lot of people struggling with as they begin their financial journey.
Yeah, Mark, I'm a little curious as to your upbringing, right? When it comes to certified financial planners, from people I've been able to talk to and interview, and not even on just this podcast, just in general, outside of this podcast as well, it always seems like there's something about money that kind of screwed them over, that made them in the future want to help others not have to go through that. Was there a moment like that for you? You mentioned coming out of college with $120,000 in debt across between you and your wife. But what was that thing, that finance experiment that might have gone wrong that made you feel called to now help others do this for a living?
Well, it certainly, there's several chapters to that book and I won't bore everyone with everything, but one of my first memories with money was around age 5 or 6. And somehow as a little kid in the 80s, I'd been able to scratch together $50 and I'd put it in a paper bag and put it in my sock drawer basically. And from all the lemonade stands or allowance money. And at $50, you could open up a checking account at the bank. And I didn't know this. I'm a 5-year-old. But my mom wanted me to like figure out this banking thing and understand how banks work and that sort of thing. So she took me as a responsible mom to the local bank, and I had my paper bag in my hand, and her job was to do the paperwork and get all this set up. And my job was to hand over all of my money, my life savings, to an absolute stranger, and just trust him that he was going to keep it safe. Now, I didn't like this, and I ended up doing it because I was told to do. How many financial decisions do we make because we were told to do it? But I trusted my mom. I trusted her, of course, implicitly. And I didn't trust this guy, but I handed him my money anyway. And little did I know as a little 5-year-old kid how right I was to be skeptical of the bank. And now fast forward, I'm in a dirty hotel room signing my life away, basically as a freshman, 18-year-old kid, and not knowing exactly what I was doing. Fast forward a few more years, and now I'm underneath an elevator with my master's degree in my back pocket, feeling so proud and egotistical. But I'm under a elevator with a shop vac, sucking out all the filth and doing property management, working 3 jobs, nights, weekends, whatever I could do to make that slave payment every month to Nelnet and Sally Mae and all of the banksters that I owed all that money to. And meanwhile, I'm listening to the world coming to an end. It's hard to go back to those days, Now we think about it in hindsight, but you didn't know if there was even going to be banks open for weeks at a time, right? And now we just finished, as we're recording this, it's the end of 2022. And we've had another major turbulent year in the markets. And I don't think, John, I don't know about you, but I don't think we're done with volatility yet. Yeah. So I guess the story there is banks are the oldest, I would say the oldest financial profession in the world. And they are still the most profitable business you can be in. In fact, there's a great book out there by David Graeber. It's called Debt, the First 5,000 Years. What? 5,000 years. That means banks are as old as cave paintings. Or at least I should say banking is as old as cave paintings. Because banks, as we understand them today, didn't exist up until very modern times. It looked very different. So this I believe that this concept of banking is actually intertwined with my story with money. And the banker is, I'd say, the closest thing to a villain I have in my movie plot so far.
And that's amazing. And one last question before we really dive into today's topic that I wanted to ask you is, from when you were around my age, right? If you could flash back a little bit, is this what you had your eyes set out to do?
Well, that's a great question. I don't think so. I didn't get a degree in finance or even business. I just knew I wanted to help people. I actually got a master's of divinity, which helps you get into churches and church leadership. And funny enough, that whole degree, undergrad and then graduate degree, I learned like ancient Greek and Hebrew and stuff that, I jokingly say my favorite book of the Bible is the book of Numbers, because I never really wanted to be like a minister or pastor or anything like that. I just knew that I wanted to serve and help transform someone's life in any way I could. I did volunteer with a church for several years and knew that I needed a full-time job to cover the bills. So I stumbled into a CPA firm as one of those 3 jobs, the restaurants, the property management, and working for a CPA. And all of those jobs cobbled together helped me cover that monthly student loan nut. But at really, I guess at the core of it, it was just, how do I help people have those transformative aha moments in their life? And funny enough, there have been more tissue boxes used in my financial planning conversations than even were used in the ministry work that we would do volunteering and still do. So the surprising thing is that money gets right to the heart of somebody, which again, as a Christian, I think to myself, that may be why Jesus spoke more about money than virtually any other topic, and our relationship to money, how core and important it is. So anyway, point is, I really didn't see myself becoming a financial planner until I woke up doing it. I was working for a CPA, just sort of doing part-time work for her, helping her get tax forms ready and that sort of thing. But I overheard those calls that she would make. Like, I'm sorry, Mr. Client, I'm investing your money. I know you're 63 years old, but I just lost you a third of your savings or half your life savings because it's 2008 and the world's coming to an end. Sorry about you. Click. I'm like, what? I can't make that call. I almost got out of the business, out of the industry, because I didn't want to have that phone call to just devastate someone's life like that. No way. So I almost left the financial industry when I saw that was a potential outcome.
Yeah.
But I stuck with it, found strategies that had nothing to do with volatile markets, and here I am today.
Amazing. And I love that you brought up the Bible. And it's like, a lot of people say it's kind of outdated, but it's like, if you take the stories and the lessons, it's so applicable no matter, I always say like true wisdom stands the test of time, right? It'll be always be applicable. Just how you apply it looks a little different. And you just got to use your mind a little bit to see how you could actually play it out in the real world. And I'm glad you were able to. And so kind of to dive into today's topic a little bit, right? Financial planning. I kind of wanted to start, very simple. What is a financial planner, and why on earth should anyone speak to one in terms of when it comes to money?
There's no definition of the word financial planner in any official sense. And that can be dangerous because a lot of people can just wear that on their name tag. Financial advisor, financial planner. There is something known as a certified financial planner, but anybody who puts the name financial advisor, financial planner on their name tag or email signature, just do some more research. That's all I can say, because they may or may not have your best interest at heart. They may or may not have any more education than you do about what you're trying to do, financially speaking. So it matters the kind of work that the person had to. If doctors had that same standard, if anybody could just call themselves a doctor, I would be very careful who I took drugs from or got under their knife for surgery, right? So yeah, the first and foremost is a financial planner is someone who hopefully has gone through a certification. I've been through the certified financial planner process. I've been trained and designated and stamped with that seal of approval. I follow a specific process. I have a certain quality standard I'm supposed to meet. So that's the gold standard. A certified financial planner will, first of all, listen to you. That's core. Again, kind of like a doctor. You don't want the doctor just diagnosing you before he or she has listened to what your ailments are, what your goals are, that sort of thing. So that's what we would do. We'd have a one-on-one over the phone or over Zoom, and we just listen and understand what you're trying to do, what you're trying to accomplish. I think the better financial planners, certified financial planners, don't just rush to judgment, and they don't try to just dump a bunch of information on you. They try to draw out of you what's already there. They want, hopefully I try anyway, to really educe from you, what is it that you want money doing for you? I don't need to be anybody's financial guru. I don't need to tell you how the financial overlords work this world. I don't need to be the financial Yoda in your life. I just want to be someone who can tell you, hey, look, you are your own best investment. And if you put that 4-pound knot of neurons in your head to work, and with a little bit of input from me and help from me, kind of like a farmer, I can't make those plants grow, but I can water, I can create an environment, I can till the soil, whatever. You are your greatest investment. So what are you going to do with this beautiful thing we call life to make the very most of it, to lift that sorry to mix the metaphor, but how can you lift that plant out of the earth and grow into something beautiful? Yeah, definitely.
And I love that you mentioned it. And it's crazy how, no matter what the industry is, like some of these things that it just, it applies in multiple industries. For example, with a real estate agent, if you're going to sell your house, right, you don't want that agent that says, yeah, I just sold neighbor's house down the block. I sold this house. I sell houses all the time. Number one agent. I got a team of 7 people. It's like, okay, we get it. You're good at your job. But as you said, people want to speak. You got to get down to what's helping people, what problems are people really facing? What problems are they facing? And then you also have to realize what problems do they want solutions for, right? Because, and that's something that even in my relationship, right? It's like, sometimes it's like, I'm a fixer, I'm a builder, right? So it's like, if something's wrong, it's like, don't come to me because I'm not the shoulder to cry on. I'm the person that you come to when you want to fix things and get them right back on track, right? It's like, but some of those problems aren't the problems for me to solve, right? And the same thing in financial planning, and same thing with real estate, right? It's you have to really listen and hear kind of where are these people coming from. And now I kind of wanted to ask you, right, when it comes to a financial planner, at what age do we begin reaching out to one? Do we begin speaking to one? Because as you said, financial literacy is very, very, very low in this country, right? In most countries, right? It sucks that it's in this country as being one of the most prosperous countries, but At what point do we reach out to one to kind of get some of this information and just start having conversations around money?
Yeah. Well, that's a great question. And it's hard for me to really say anything other than right away. And I realize that's sort of like asking a barber if you need a haircut. So I get it, but it's true. The most valuable dollars you'll ever have in your lifetime are the ones in your pocket right now. And I don't just mean your physical pocket. I mean like your bank account. Like today's money is the most valuable it will ever be. And that was my trouble I had as I was paying off my student loans. I was in my early 20s and I was throwing all this really valuable money into a hole that I'd never see work for me ever again. Mm-hmm. I was helping the student loan companies get to their retirement goals while I was losing years of my life as a slave to their retirement plans. So the money in your pocket right now has more power in it than a 60-year-old's money, if that makes sense, due to something known as opportunity cost. All right. So that's the first piece, is the money in your pocket you got today. Now, you might not have a lot of money in your pocket. I didn't when I was just getting out of college, but you also might have an income. I didn't even have that, really. But if you got an income, think about it this way. List out all your assets in your mind. Take a minute, think about it. What do you got? Okay, you got savings in your bank account. You got your 401k, you got your Roth, you got your crypto, whatever else you got. I bet you didn't list the most valuable asset, and that is your earning potential. And a lot of financial institutions will calculate your earning potential. What is your earning potential? Well, let's say you make 50 grand a year this year, 50,000 bucks. Not a lot. Maybe it is a lot. Depends on your situation. Of course, if you're young, and single, whatever, that might be a good chunk of income. But what is 50 grand? Well, if you never got a pay raise over 35 years, first of all, that's a shame. But second of all, that's $1.7 million that you're going to earn over your lifetime. So where is that money going to go? And what if you got a couple of pay raises over the years? I mean, if you got a couple of pay raises on 50,000 bucks over the years, that's a lot of money that you're losing out on if you don't put some of that money to work. If you just got a 3% raise on that 50 grand annual becomes 140 grand annual over 35 years. Just plain cost of living adjustments. Okay. So where's that money going to go? And the most important question is really, one, can I live within my means? Mm-hmm. I really can't help you if you are unwilling to do that. That's your job. I can give you some ideas and tips and hacks on how to do that, but you got to live within your means. And another way to say this is you got to fight against what's called Parkinson's law. Parkinson's law says that your expenses will rise to equal or exceed your income. Your expenses will rise to equal or exceed your income, meaning I can always outspend my income if I'm not careful. So that's the first piece, is how do I defeat Parkinson and his law? The second is, where should that money go? Now that I can live within my means, I've got $200 a month that I can save, or $2,000 a month that I can save, whatever. Where should that money go before I need it again? Mm-hmm. And that's the journey of financial planning. Budget counselors can help you with Parkinson, but a financial planner is there to help you with number 2, which is, what does this money need to do for me? And that's honestly one of the first questions we ask our clients is, hey, if you could just, this would be a fun thing to do on our show here. John, let's do this, man. So, all right, let's experiment. I'm giving you the magic wand. I'm giving you the Federal Reserve magic wand that they don't take out except once a year. You get to wave this magic wand and create a brand new financial vehicle.
Okay.
Poof. It's legal. Whatever it is, it's legal. Okay. And you can put your money into it. What does it do? What sort of characteristics does it have? What sort of attributes does it have? It can be anything. It can do anything. Your money can, in this little magical financial vehicle, can act any way you want it to.
Yeah.
So it's not a 401k. It's not a Roth. That just, what is the function of the money? Help me out here. What do you want it to do?
So if I were to create a brand new vehicle today, it would compound daily. I would be able to put in dollars pre-tax, and then when I take out, it's tax-free.
Love it.
And for the most part, there's no cap. There's no income limit. There's no income threshold. There's no cap on how much I can input per year.
How about passive income? Can we get some passive income off that thing?
Yeah, we get some recurring dividends monthly, and also it's also self-directed. So I can put whatever I put in there, I can and use that money to put into whatever I want. I think that'll be my magic vehicle.
Yeah, I love this. Is a great. That's a great answer, man. That's a really good. Some people don't know the first thing to say, but you gave me like 5 things there. That's awesome. I'll throw a couple more in there because those are all good. I agree with all those things. How about private? So nobody knows that it's there. So it can't be sued or taken. You can't be sued and it take away from you in a lawsuit or something. Hate to say it, but that's the reality of the world we live in these days. How about using it as collateral? I want to be able to use it, like have this asset, whatever it is, and then borrow against it so I can go put twice the money to work, right?
Yeah.
Without it being called like a margin loan. I don't want any of that mess. A margin call. Yeah, you've done a great job on that. Yeah. How about some guarantees? How about some sort of like protection that I'm never going to lose money in this thing? Guaranteed.
Yeah. I have another thing. So let's add some more, right? So another one I would probably add, right, is no pre-takeout penalty. So I can take my money out whenever I please.
There you go.
I can also pass it down without having to pay inheritance or like trust or sales, something like that tax, right?
That's great. Those are both great. Yeah. No, you don't want to be penalized to take it out too early. Let me also throw on, because I just got off the phone with a lady. She's angry because she's forced to take money out of her IRA because now she's 72. And when you turn 72, I know, folks might not know this. A lot of folks don't, but you're forced to take money out of your IRAs, even if you don't need the money, because the government's tired of waiting and they're ready to take your taxes off that money. So no required early withdrawal penalties and no required minimum distributions for waiting too long to take the money out. We want to be in control of when we take that money out.
Yeah. I didn't know that was a thing.
Yeah. Isn't that funny? Yeah. If you started your 401k, this is a crazy statement too, but if you started a 401k when you're 20 years old and then lived till you were 85, which is the life expectancy, you would go through like 40 years where your money's in a penalty zone from 20 to, 60. So what is that? Is that 40 years? Yeah, 40 years. Because you'd be penalized to get the money out too soon, 10% penalty. A lot of folks know about that part. And then you enter into this like 13-year magical zone where there's still a tax due on your 401k.
Yeah.
But there's no penalty. That's the only time in your life you can get the money out and there's no penalties associated. And then when you turn 72 until 85 or however long you live, there's the penalty of 50%.
Wow.
50% is the penalty of what you will be it's what you'll be penalized on, what you should have taken out but didn't. So if you should have took out 10 grand out of your 401k but you didn't, they'd take $5 grand out of your pocket as a penalty and then force you to take the rest out with taxes. So anyway, that's 85% of your lifetime in a penalty zone with your 401k or your IRA. So who's that financial product built for? Anyway, I'm off my soapbox, but boy, what if every American took 10 minutes for free with a notepad in their or whatever, an app on their phone, and just listed out what they want their money, like you just did.
Yeah.
How cool is that? Like, rather than just following like a herd, like a member of the herd going off the cliff with their money, they think about, well, what do I want my money doing for me? I think most of us don't ever stop to do that. And yeah, if you could, boy, I think maybe we could direct our money in a more efficient way.
Yeah, I would add one last one that I kind of just thought about. I could use it to deduct taxes off my personal income. So income that I invest and put into that vehicle, that magic vehicle, I can now, same thing like how a Roth kind of works, and like I contributed to it, so now I can write that off come tax time in the spring season.
Oh yeah, that's great. Another really creative idea there, man. Yeah, and when you use it for investments, maybe we could make that deductible as well, kind of like an HSA. When you buy medical equipment or whatever, you can deduct that too. So, I love it. Great stuff. Well, so that was sort of the starting point of a question you asked a while back, which is just like, hey, what are our first steps in a financial plan? And I said, hey, let's live within our means and let's figure out what we want money doing for us. Any other insights before we move on?
I mean, that was pretty interesting because it kind of gets me to think about. So I always was against the Roth IRA. It's something about having my money trapped. Yeah, it's post-tax money you're putting in and you could take out tax-free, but there's still a penalty. And it's like, but then there's also an income limit as well. And then there's also a contribution limit as well. And there's so many different things. And for me, I always had a feeling like, hey, I'll just invest in a regular taxable brokerage account. So when the time comes that money is in abundance, I can access that easier and put that elsewhere because something about waiting until 60
Yeah.
and having someone tell me what I could do with the money I worked hard to earn, it just didn't sit too well with me, right? So that's the same reason why I didn't go the corporate route. Something about authoritative figures telling me what I have to and have to do doesn't really sit well.
I'm with you on that, man. Yeah, either you're going to do something with your money or someone else is going to do something with it. Either you're working for your plan or you're working for the boss's plan.
Yeah. So then let me ask you, once you do this kind of exercise, where do you go from there? Because I got a lot of thoughts in my head as to what I would like, but reality is I'm not going to have a magic wand, right? Magically appear, but I do have a lot of good ideas. So then from there, where do you kind of go next?
Well, I can only tell you what I answered and tell you my story. Every client I work with has different answers, but a lot of them are surprisingly similar, and they're very similar to what you said. I mean, if we were to just take a poll of the average American, they would have a similar set of answers to what you and I just went through, surprisingly.
Yeah.
And why not? Right? So for me, I similarly had answers to those questions like you just said. And so that's kind of when I started digging into the CFP. And I said, well, let me find, because again, I didn't grow up knowing this stuff. So I said, let me go find where money can be put. Where can I allocate my precious dollars? I'm in my 20s. I want to put this money to the best use. So I looked at everything. I looked at stocks, bonds, mutual funds, exchange traded funds, target date funds. I looked at real estate. I looked at REITs. I looked at annuities. I looked at, the list goes on, but none of them really fit the requirements. I counted 400 plus different places I could put my money, all the way down to like super complex dynastic trusts to figure out, well, what can I do with this money? Plus I got this major problem of my student loans. So, it was a highfalutin like exercise mentally, but it was also like, holy crap, I got to get rid of this monster nibbling at my butt every month because I'm trying to get out of this debt. And okay, so of all things, I stumbled across a financial tool that met all of what you and I just talked about. Literally, I mean, the full checklist that you just said was represented in a very old conservative financial product that's been around over 200 years. And the more I looked at it, the more I was compelled by it and couldn't look away. And of all things, it was a form of dividend paying whole life insurance. And I'd stopped like searching at that point because it really did. It met everything I needed. I mean, it's not perfect. Nothing is, but I'll explain a little bit about how it works. And I'll specifically define it as a bank on yourself designed whole life policy, because it's not like the kind that you may have heard people think about on the radio, like Dave Ramsey and Susie Orman. It's not just the life insurance is sort of the afterthought. It's there and it's going to be an incredible gift to families someday. One of your lists and your requirements was how did you say to pass it on?
Yeah.
To leave it? It's left, of course, it is insurance. So you're going to leave your family a big lump sum, income tax free. I don't know too many things that can do that, right? If I leave a big bucket of money in my savings account, my family gets taxed on that every year. But if it's in life insurance, it's income tax free. But that's the later on time. Let's talk about like what we can use it for today.
Yeah.
It's way more fun to spend money while I'm alive. At least that's kind of how I view it. So it does a few things really well. Number one, there is a death benefit, but there's also, if it's cash value, dividend paying whole life insurance designed the bank on yourself way, it has a cash value. That's the kind of the savings, the money I can spend while I'm still alive, while on this side of the grass. And that bucket of money is growing on a guaranteed basis every single year. So this means doesn't matter what the stock market's doing, doesn't matter what the real estate market is doing, it's going to grow guaranteed contractually every single year. Second, first of all, we could stop right there because that would be awesome.
Yeah. So let me ask you a quick question, right? So usually most people might be thinking, what's the catch, right? It's guaranteed to grow every single year. I know there's like I'm invested myself and there's a treasury inflation protected bonds where it's like it's guaranteed to grow at least above inflation every single year. The only catch is that it doesn't really grow all that much. So is there a catch kind of to the guaranteed growth?
Catch? No, you can put as much as you want into a whole life policy, as much as they'll approve you for it, the insurance company. Yeah. So unlike I-bonds where you're capped out at $10,000 per person, there's no cap on how much you can put in, no government cap on how much you can put into a policy. The catch might be that you're going to have a conservative growth rate if it's guaranteed.
Yeah.
But on top of that, and so that's maybe a catch, if you will. It's going to be modestly keeping up with inflation, let's say, somewhere in the middle single digits on a guaranteed basis, middle single digits. On top of that guarantee, icing on top of that cake, the insurance company will also kick in dividends, which are more sensitive to rising inflation in a good way. So dividends are more money that gets dumped in to the policy's cash value of the policy. And that dividend has been as high in the early 80s, 1980, when mortgage rates were 15, 18%. Dividends were in the double digits as well, 12, 15, 18%. So in these turbulent high inflation times, in the next year or two, I expect to see dividend rates begin to rise, keeping up with inflation. So that's the first, is that it grows on a guaranteed basis. Yep, go ahead.
So let me ask you another couple questions, right?
Yeah, sure.
So for the dividends, is the dividends coming out of the investment choices that you make within the insurance policy? Where are the dividends coming from?
Well, in this case, I would actually classify whole life as something other than an investment. It's not a security. It's not tracked by the SEC. It's an insurance product. And the insurance company is doing the business of insurance. They're selling policies and paying out death benefits. That's their business. If they don't need money to pay out to claims like death benefits, then they're going to put that money to work in fixed income like bonds, real estate, mortgages, and they take the risk. See, what is the definition of insurance? Well, it's the transferring of my risk to the insurance company. That's the definition of any insurance, whether it's auto insurance or life insurance. So in this case, the insurance company is saying, hey, even if we pick the wrong mortgage or the wrong real estate deal, we guarantee that we're going to pay you more money this year than you had last year. And so the dividends are not guaranteed. There is a guaranteed increase in my wealth. There is a guaranteed increase of my cash value, but the dividends can fluctuate up and down. Now, I like companies, and I only use insurance companies that have paid a dividend without fail for at least 100 years straight, like consecutively 100 years. So they're pretty solid that they're going to stick around and keep paying out dividends to go 100 years like that.
Yeah.
But that is where the dividends come in on top of that guarantee.
Yeah. One more quick question. Sorry.
Yeah.
And so when it comes to dividends, you said depending on how their investment do, also that factors into how many dividends we receive. Because it sounds like if they make a bad choice at some point, and especially if they keep on growing, they get more life insurance policies, it'll reach a point where they can't find enough money to distribute to all the policy holders, right?
Yeah. They can't put a lot of the money into things that can go down in value. They're not a mutual fund.
Okay.
And they're not an individual investor like you or I. They're not mere mortals. They have to retire and so forth. They're a mega 100-plus-year-old financial institution with hundreds of billions of dollars in their general account. And a good chunk of that money is just sitting in cash or cash-like equivalents. The rest of it is conservatively invested into corporate index, held to maturity corporate bonds or mortgages that just pay a coupon payment, and there is no principal risk. They don't care about the price of the bond. They just care about that monthly payment they're getting so that they can operate their business and pay out death benefits, because they're working on a operation called life insurance.
Yeah.
There are 10,000 35-year-olds that are that own policies with us. 2 of them are going to die. 2.2 of them are going to die this year. So we know exactly how much money that needs to mature off that bond to pay out those death benefits. That's getting a little wonky, but that's kind of nerdy talk there, but that's how their operation works. They don't care about the stock market because they have virtually none of their money is exposed to market risk in that regard.
Okay, that makes sense.
But even if all of their bonds went to zero, they still have the cash sitting there to pay us our guarantees.
Okay, that makes sense.
So that's the big one. That's the first one, is that this thing grows in such a predictable way. We can count on it. We can actually call it a financial plan. Go figure, right? The second piece to this is it's accessible money. Second is it's accessible. Cash is liquid. We can use it for whatever we want. The money goes in. It's after tax, like a Roth IRA. And then we can get the money out anytime we want. We can be 29 and a half, 59 and a half, 99 and a half years old. There's no penalty to get the money out. It's our cash. We can use it for whatever, and it's tax-free when we get the money out. So much like a Roth IRA, you can get the money out with no taxes due.
Yeah, so let me ask you, because when we had the last conversation with Stephen Nagy, he mentioned pretty much, let's say I were to invest $10,000 in year one for my life insurance policy, I'll be able to take out like 4,000 or something like that to you. I'm just using rough numbers. I don't remember exactly the numbers he used as an example, but you'll be able to take out a certain percentage of that money to then be used kind of like as a loan or something like that, as collateral, as you mentioned, while the 10,000 that we originally invested stays and grows. Does this policy that you're talking about have something similar to that?
Yeah, that's right. That's actually the third piece to this puzzle. Is no, you're spot on, man. Yeah, generally speaking, you can get access to about 90% of whatever your cash value is at that time, and you can withdraw the money or you can loan yourself the money. Mm-hmm. So I just got off the phone with someone who is going to buy a camper van, and they're going to do #van life basically, and they're going to borrow from their policy and pay cash for the camper. And meanwhile, the policy continues to grow and compound as if there was no loan. So even on the capital she borrows for the camper, the policy is still growing uninterrupted compound growth on the cash. Mm-hmm. Meanwhile, she's driving the van around. So this to me was the best way to pay off all my student loans. Yeah. Why would I pay cash to pay off all my debt? Instead, and now we've trademarked the snowbank method. Now what we did, instead of paying off those debts with directly paying cash for them, what we did was we plowed as much money as we could into our policies, and one at a time, we borrowed against our policy to wipe out our student loans. This gave us an asset that was still growing for our retirement, for our future, for our other life needs, and we were paying off those bozos at the bank.
Okay. So let me ask you then, right? When it comes to, it sounds kind of counterintuitive for someone that doesn't really understand this too well, but you're essentially taking out a loan to pay off your loan. Why not just pay off the loan?
Mm-hmm. Yeah, why buy back your debt if you could just pay it off, right? Well, so what do you have to show for your money after you've paid off all those debts? You have a bunch of thank you letters. Thank you for your payment. Thank you for your payment. I can't spend a thank you letter at the grocery store, and I don't get a rate of return on that thank you for your payment letter, do I? No. So if I owed 120 grand, which is what I ended up having at the start of my student loan payoff journey, the real price of that education was several $100,000. Yeah. It wasn't just 120 grand. It was whatever 120 grand would have earned for me had I not gotten into debt or left the money invested instead. Over my lifetime, that's a lot of money. That might be $500,000 or more. So instead of paying off those banks and starting with a net zero of my life, I didn't want to be 5 years older and just finally getting to the start of my life. A lot of clients, young clients in particular, will come to me and say, well, Mark, I got all this debt. Should I pay off my debt or should I save for my future? Yeah. And that's the quandary I had too. But where is it written that we have to choose between those two? Mm-hmm. Like, why do I have to follow their rules? What if I could be my own banker and borrow from myself and buy back my debts from my creditors? This is how banks do it all the time, by the way. And now I've got an asset earning for me, guaranteed, and I'm free from their student loan payments. And now I'm in the driver's seat. I'm in the banker's seat. I can pay myself back at whatever rate or pace I wish. And that's what we did. We paid off our policy loans, and now we're not only student loan debt free, but we've got the policy loan back in our policy, and the policy continued to grow uninterrupted.
Yeah. So what other kind of things can we kind of expect from getting into life insurance? You mentioned 3 so far. So we talked about how we can take out the money penalty free at any age, no matter what age. We can pass it on free as well, tax free. We talked about, how we can
grows on a guaranteed basis with dividends dumped on top of that. Yeah, we've talked about how uninterrupted compound growth basically solves the biggest problem in the financial planning universe, which is we always keep breaking compound growth with mutual funds, brokerage accounts. Every time I spend money for a cup of coffee, I'm breaking compound growth. Yeah. Certainly for things like cars or a down payment on a house, but this solves that problem, right?
Yeah. So then let me ask you, right? So, because you're the second guest I had to kind of talk on life insurance, and you guys both speak very highly of it. Why is there such a negative connotation? Why is there such a negative, stigma or stereotype around life insurance? Like if it's not used car salesmen, you guys like, and realtors as well. I just, which kind of sucks me being a realtor, but it's like but why life insurance has that negative connotation behind it.
If I could be talking about anything other than life insurance, believe me, I would. And as a certified financial planner, I'll quickly share, I don't recommend this to everybody. And I don't think it's a perfect fit for everybody. And this is why, again, you start with listening. You start with understanding a person's goals. I just think not enough people know that this is an option. So I'll try to answer your question now. There are 400,000 life insurance agents in the United States, and 99% of them have no clue what you and I are even talking about right now, man. They aren't trained. This is not part of the licensing training. It'd be sort of like, I don't know what kind of realtor work you do, but maybe it's, let's say that you have a very specific niche selling like high-end luxury beachside resorts in Miami or something like that. Not every real estate agent or a realtor knows anything about beachside property in Miami. You got to have special, maybe there's even a certification for beachside Miami properties. Mm-hmm. And in fact, I went through what's known as the Bank on Yourself Professionals certification process to get this like extra credit authorization, because there are so many other guys and gals out there on YouTube calling it all sorts of things. Infinite this and family wealth banking that, and there's no quality control unless you are using someone who has a Bank on Yourself Professionals certification in their email signature or on the website. So that's why I went through the Bank on Yourself Professionals training to get that certification so that folks knew what they were getting into. So why don't more people have a favorable view? I think mainly it's because most insurance is not designed this way. It's not all Miami beachfront property. And then second, there's plenty of folks in Wall Street who would prefer you not put money into life insurance, but put it into their products instead.
Yeah. And definitely makes a strong point. And let me ask you, right, when you some people do end up getting on the phone with life insurance, right? A lot of the times, just like any other sales profession, it's because you guys are doing outbound calls, right? A lot of time when you're cold prospecting. And then let me ask you, if we were to get a call from a life insurance agent and hear something along the lines, right? As you said, there's no quality control. So anyone that's a sales agent or a sales professional, usually pretty good with their words, it wouldn't be hard to find yourself in a gutter. So what kind of things can you kind of mentioned to be your own banker designation? What else can you kind of look for when talking to someone that does life insurance? So, because I have someone else that I know personally that I actually used to work with that does life insurance. And at that time, this is before I started the podcast, before I even heard that stuff like this existed. I myself, me and one of the guys, actually, one of the boys that I was supposed to start the podcast with, hopped on a call with her, and they were talking about life insurance, and I was extremely skeptical. So, like, what kind of things can you look out for, or should you look out for?
Well, the shortest thing I can do and the best way I can answer that question is to know what you want before you get into those calls, because folks will pull you in one direction or another. So again, starting with, what do I want my money doing for me?
Yeah.
If we could be doing this with a bank account, we would, but bank accounts don't let us do this. If we could be doing this with a 401k or a brokerage account, nope, can't do it with that either. It's got to be something that has all the right components to become what we've been describing today. If you want something else for your money, boy, we're a full financial firm. We can talk about IRA rollovers and Social Security strategies and real estate strategies and more. This just happens to be something I think would help a lot of folks who have the particular needs I had with regard to debt payoff and more.
Yeah. And then for younger people, I'd say the first, objection I could probably think of is, I'm young. Why do I got to worry about it? Right? Why do life insurance, right? God willing, I have another 50, 60, maybe years left. Why on earth do I start thinking about it now?
Yeah, honestly, if we could be calling it anything other than life insurance, we would. I mean, it is life insurance and it will be there someday. But the point when I got it in my 20s, I wasn't thinking death benefit. And thank God I'm still here breathing. But the main thing for me was, how do I not just lose all this money to the ether as I pay off my bankster that were coming after me? So for me, the biggest issue was not the death benefit. It was all of what the living benefits could do, the cash value, which I've mentioned earlier, but it also becomes a stream of income in my future retirement. It'll become the way I pay for my kids' college. It has been how I've used it for my business investments, real estate investing, buying my cars. Heck, we went on a month-long trip to Hawaii off of one of our policy loans. And all the while, the policies grow compounding like there was never a loan taken. So for me, that's what's got my attention. And it's what I think has built for me a financial plan that I can really count on.
Yeah. And so then let me ask you another question then. For the life insurance policy, is it like a thing you get one time in your 20s and you have that policy forever? Do you open up multiple policies to use the benefits? Is like, what are some of like the, different ways you could probably use that life insurance or leverage it to maximize, what you get out of it?
Well, yeah, we talked about how you can use it as collateral, and the life insurance will be a boring middle single digit rate of return over a long period of time.
Yeah.
So it's never going to be triple digits by itself. But I'll tell you a story. I had a guy who borrows from his policy in a regular way to go invest in alternative investments, mobile home park investing, ATMs, product investing, equities, and his business partnerships. And he's doing incredibly well in his investments. But even if he failed, even if the business flopped, his policy still compounds. So that's a stop loss on his investment choice. And if the markets are great for him and he does really well with his investments, well, his policy just adds to that overall rate of return between his crypto that he invested in. But if he borrows from the policy and it goes up, then it's like a double win.
Yeah. Okay. And then let me ask you, what is the minimum necessary to get into this stuff?
Yeah. The more you put in, the more you have. But I get it. My first couple of policies were pretty small, relatively speaking. I would say that if you can't save $200 to $300 a month, probably should be working on the first rule, which is living within our means first. And that's about where the minimum starts for younger folks, $200-$300 a month, something like that. Now I've seen it a lot larger. I've seen it a little bit smaller, especially on younger kids. But in that range of $200 to $300 a month is probably our minimum starting point for one of these policies. Anything less than that, it's not going to grow very efficiently.
Okay. And so, Mark, you dropped a ton of gems in this episode. How can we connect with you to kind of learn more about this and decipher this? Because this is one of those, you're not taught this in school, right? This is not one of those conversations you have at Thanksgiving and your uncle tells you. And this is one of those conversations, you're not at the golf course. If you're not around these people in these mastermind calls or podcasts, right? You're probably not going to hear about. So where can we connect with you that we could find, even if it's not about life insurance, but just connect with you in general so we could find out some of the other things you offer and some of the other ways we could have our money work for us?
Yeah, you bet. Well, we have a weekly show at notyouraverageFinancialPodcast.com if you want to learn more about some of the strategies that we have been just stumbling across and that I've had the great privilege of working with other clients on. notyouraverageFinancialPodcast.com is the website there. If you want to meet with me and have a 15-minute chat, I can answer your questions and see what strategies like Bank on Yourself might be a good fit. You can go to kickstartwithmark.com. That's kickstartwithmark.com.
All righty, Mark. And now it's time for our final 4 questions, the way we end every podcast interview. Question number 1, what is the most impactful lesson that you've learned in life?
Wow. Well, I'd say one of my biggest ones is to relish the gift and share the gift, to truly relish what you've been given and to give it all away.
What is the most admirable trait a person could have?
Activating their potential, watching them lift off from their launch pad and see how far up into space they can go.
If you had to change someone's life with one book, which book would you recommend?
Well, got to be hokey and say, check out The Bank on Yourself Revolution right behind me there. Great book on money. Great book on this topic that we've been discussing today. But man, there's so many books out there. Let's see one more in addition to The Bank on Yourself Revolution by Pamela Yellen. How about The Road Less Stupid by Keith Cunningham? Great book on avoiding mistakes.
Sounds like I haven't heard of that one before, but I like the title of it, so I'm gonna add it to my reading list.
Yeah.
And then, what is the legacy that you're trying to leave behind?
Well, yeah, I'd say, wouldn't it be great if I could just be a great father, a great business partner, and a great friend? That'd be a great thing to put on my tombstone.
Amazing, Mark. Well, I had a pleasure talking to you today. I got a pleasure going a little bit in depth into life insurance again and kind of getting a better understanding as for what this could look like and how this actually works. So I appreciate you hopping on and dropping, the gems that you did and sharing the stories of your personal life and your professional experience.
Thanks, John, for having me on.